associate member of T3 Trading Group, which is an SEC registered broker-dealer, and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There is the position disclosure. Okay. So we're down 87 cents already. So right now it says we're flat, but we closed green. Markets dropped 80 cents or so. The SPYs have dropped 80 cents or so since the close. So it was a small green day today on Wall Street. No big deal. Nothing much going on. Just a small green day. Qs here have also dropped 90 cents after hours to tick back to red, but they also closed green. So small green NASDAQ today. No big deal. Nothing to see here. And the IWM did close negative a little bit. It's also down a bit from where it closed. So Russell's up off 0.5% or so. And the TLT recaptured that $85 with authority. So $85 continues to be the huge level in TLT. It managed to close flat. At one point there was a big gap down in the TLT. 85 has been huge support on that ETF, as has 4.5% on the 10-year. It's been a really important level we've been paying attention to, but you can just see it. I mean, that's a hell of a snapback candle here on bonds. They really bought the bonds back up. 85 is a huge level. It was a big level in January, and I remember we were getting concerned about it into 85 in January. It's the low of the equity bear market, at least thus far. And today, they were able to gap us below that key 85, but immediately got us back above, held above, and were able to recapture the level. So 85 remains hugely important in TLT. I've been of the thought process that if we really begin to lose that 85, that's when the equity market starts to pay attention to what is maybe an impending disaster on the bond area of things. So we'll see, but so far so good. And with the TLT rallying back off of those lows, you better believe it, the market had an incredible snapback. That's in the face of a lot of negativity. It seems like the headlines are starting to turn, I think, overall a little bit more negative again, but this market is just absorbing any and everything. Obviously, everyone knows by this point that Moody's downgraded U.S. debt on Friday after the close. That led to a huge sell-off Friday after the close that was continued overnight and pre-market this morning. So you could just see we sold down off of U.S. debt getting downgraded by Moody's from like SPY 394 all the way down after hours to 388. This was a $6 down move. Then this morning we were down as low as 386. So this entire down move here was basically $8 down in the SPYs, and we more than recaptured that. We were able to break Friday's highs, which is mind-blowing. Circling back just to kind of review the thought process for today, the gap down was large. It was the biggest down move we've seen in this market since this day back here, Monday, April 21st, when we were identifying the potential of a big positioning squeeze that could come into the market. So biggest down day we've had since then, potentially this morning, with a 1% plus gap down in the S&P. I think the Qs are off a little bit more than 0.5%, something like that. And in some ways, the most interesting thing was that was as large of a gap down as it was, but wasn't even down to the ADMA on the daily. And it happened immediately after OPEX, so that makes it a little bit more interesting to see a potential negative catalyst come in after OPEX, even though this May OPEX did not do a whole lot to change the gamma profile of the market. Always interesting to see, oh wow, OPEX just happened, now we have a catalyst here. Maybe this is going to put some of those long buyers out of the money. We'll see what happens. And again, the gap down this morning could have been viable, but I thought it was too shallow in the context of the daily chart. Last week was one of the most bullish weeks in, you know, the history of my trading career. We had the really big gap up on Monday a week ago on the China US pause, and that just led to an escalation of the positioning squeeze. Short term tactical closed in the red every single day last week, 5 days in the green. I don't know if I've ever seen short term tactical close in the green for 5 days in a row, but it did it. I'm actually curious to see if we're about to get a day 6 with how we closed today. Um, so it just seemed like things were lined up here to give us a pullback. Uh, Combining that extension with a catalyst, that catalyst happening immediately after OPEX. The gap down is big, but it's not even getting us to the 80 MA on the daily. There's a lot more room for that market to price correct, even within the confines of the gap down. And then we saw the systematic data. Then we saw that in a flat tape, CTAs are going to be buying another 13.4 billion, I think, worth of SPX over the course of this week. It's a little bit over 2 billion a day. That corporate buybacks are in full swing, $5 to $6 billion a day right now. So you've got, just between CTAs and corporate buybacks alone, $7 to $8 billion worth of SPX buying per day, and liquidity has increased. That's a good thing, because they can buy more without moving the market in the same way. But it's still light compared to the historical average. I haven't seen new updated numbers. Last I saw was earlier last week, but you know, whatever. You think that maybe could absorb a little bit. So, what we circled back to as a game plan for the morning meeting today was kind of, let's not really do anything immediately off the open, because we've got these two forces. One is everything I just explained initially: negative catalyst, TLT below 85, market that was super extended into the negative catalyst, into OPEX. Easily we could get more downside price correction, but corporate buybacks, CTAs, still, that endless bid is still there to some degree. It's lessening a little bit, believe it or not. It's lessening a little bit, but it's not really going anywhere. It's just going to become smaller, more small consistently over time. And I guess this week is still a relatively big week from the CTAs that can continue that positioning squeeze. So which way is it going to go? Can sellers from the Moody's downgrade and interest rates moving higher continuous lower and overwhelm the systematic bid to give us a deeper price correction? Or does the systematic bid come in? And on top of that, we discussed one other thing, which I see Dennis was talking about a little bit into the close. Funds are still under positioned in this market. If you go to Pat's note from this morning, I have it up still. It's the last thing we spoke about in the morning meeting off of Pat's note. If you look at this Goldman Sachs positioning indicator, sentiment positioning indicator thing, you could see that a few weeks ago, right when we were indicating the potential of this bigger bear market rally to come in, positioning was extraordinarily light, like in the depths of a bear market. Hey, it was a bear market, similar to 2022 positioning, similar to the 2019 sell-off that we had. I guess that was actually technically the end of 2018. I think it bottomed on Christmas Eve 2018. So that's what positioning got down to. And then after last week, it improved a little bit, but was still very light. And then even after 2 weeks ago, even after last week, it's like normal light positioning. So that's another factor that's in there. If you are an under-positioned fund and you get this gap down this morning and you've been being forced to chase upside these last couple of weeks, you might be saying to yourself, oh, great, I'm so glad that I'm getting this gap down so that I can use it to add back the long exposure that I need to have based on where the market has gotten to. So the bid off the open was so relentless that I think that this initial bid had more to do with this Goldman Sachs positioning indicator chart than it had to do with the corporate buybacks and the CTAs. I think at the corporate buybacks and CTAs, that like eternal, never-ending bid has a much larger effect in the middle of the trading session, which, by the way, tends to be when a lot more of the hedge funds are actually doing less. So it's like opening here is just positioning chase from funds that are underinvested. I'm speculating, but that's what I think. Remainder of the day was a continuation of the bid from CTAs and corporate buybacks. And that was enough to answer the question that we had in the morning meeting, where it was like, my opinion, which I stand by, was that sure, it was a large gap down this morning, but that gap down's not even getting us to the ADMA. I don't like the new longs here. But I also think that while there is room for the market to correct to the ADMA or at 580 or honestly even 570, we don't want to chase an opening gap down either compared to where we were. It just doesn't set us up for a good risk reward. So game plan for me this morning, let's wait and see. Let's watch how, this is what I love to do when we have larger gaps in the market, let's watch how the smaller time frame price action satisfies the extension on this. How does small time frame price action satisfy the extension that's coming from the gap on that small time frame? And you can just see with where we opened this morning at like 588, at that time, because of where we closed, the ADMA is all the way up at like 593. Obviously, this is a 5-minute ADMA that's going to move very, very rapidly in the beginning of the day with that much of a gap down. But let's say we went sideways this morning. Let's say we went sideways between, 588 and 589. It would have taken an hour for this ADMA to catch up. But we didn't go sideways. We ripped. We absolutely ripped. We didn't have a red 5-minute bar coming into the SPYs until the 10 a.m. bar. We went 40 minutes without a red bar. We massively price corrected to the upside. So even with a huge price correction on the upside, it took 25 minutes to correct that downside extension. And I think that this right here, this little 10-minute period of time, was the most important signal of the day. This was, okay, we just had a huge upside price correction, probably faster and harder than anybody expected, but now we're not extended on the 5-minute chart. This is going to be the important information that we get from the price action on what's going to happen next. Do we create a pivot high, dribble lower, maybe range out, eventually break down further, test opening lows, or do we pause into this equilibrium zone with the ADMA and then break up? And well, obviously you know the answer. We paused into this ADMA and then we broke up. And it was somewhere on one of these bars, it might have been this 10:05 bar, where I remember seeing just like, it almost felt like news, but it wasn't. Just like a massive, super quick, like really big upside uptick on the market. Like somebody just got stopped out or stopped in, or there was a huge market buy across the board or whatever that really triggered us up. And then that was it. It was a wrap at that point. Buyers were in control. We did have a little bit of a pullback. We created a pivot low. We retested that pivot low. I remember saying at that time, like, all right, now this 591.50 is becoming important, as is highs. I think when I got off the radio, I was saying space between 593 and highs is what's really important on the upside, and this 591 area on the downside is really important. We're ranging here. It is possible that they just overshot this upside in the market with a little extra volatility, maybe after OPEX or something like that. So now, let's see. If bears are going to be able to regain any semblance of control, they need to get us back below 591.50. And if we break above this 593, we know that the bulls are just doing the most insane comeback in history. And of course, that's what happened. The bulls broke it up. Got some weird false prints here. You can ignore those. We continued. We made a bull flag, bull consolidation. That broke out. We broke above yesterday's high. When we broke above yesterday's high, it set off another squeeze. Anybody that was short on this market, I mean, I almost wish I could take a quick poll. I probably could, but I'm not gonna. How many people out there thought that this morning the market would break Friday's high. I am not one of them. I thought it was certainly possible that we could get a bounce back. I thought it was possible that I thought it was very possible that the Moody's downgrade actually was meaningless outside of being another brick in the wall to be able to get the TLT to be able to be below 85, which could be important. Using a Pink Floyd analogy there, but yeah, I mean, I I I would have staked a lot of money on a bet that we would not break Friday's high, and we broke Friday's high. The degree of the bounce back, with especially within the confines of where the daily chart already is, like this price action today. If you just like, if you couldn't show me a daily chart and you told me, hey, this is what happened, you're gonna have a really big gap down because Moody's downgraded U.S. debt. Um, and then you just showed me this 5 minute chart. I would say, oh, we must have been extremely extended to the downside on the daily chart prior to today happening. We must have been so extended to the downside on the daily chart prior to today happening that the market was able to just absorb that news, fill that gap, and buy us back up. We're not extended to the downside on the daily chart at all. We're extended to the upside on the daily chart. We're extended to the upside on the daily chart. And this is the price action that happened. This is like the strongest market I've ever seen in my entire career. And it makes sense because it's historic. The statistics are historic in the same way that the statistics were historic on the downside in April. You know, setting all these records of worst 2 days in a row, worst 3 days in a row, all that stuff that you guys remember seeing. I don't remember them specifically. We're now seeing that on the upside. Best 5 day period, best 2 week period, or you know, even some of the little statistics that I keep in my own head, short-term tactical in the red zone for 5 trading sessions in a row. I've never seen that happen before. There's a good chance that tomorrow morning, based on today's trading session, we're at 6. I've never seen that happen before. Um, this market is historic. I've never seen a market trade this strong, this fast, this hard for so long, really ever. You know, the only thing I can kind of compare this market to a little bit is COVID. But I still think that when you're comparing the COVID situation to the current market situation, I still think it's very different. I remember even at this stage, we did an afternoon meeting somewhat recently where we actually compared the bounce back in COVID, and I was using it as an example of changing your mind because while I nailed the bottom, the absolute bottom in COVID, did really well with that. At a certain point, I got out of a lot of those longs. I started to build into shorts again, and then I was just looking at the evidence and looking at the data. And the reason why I was shorting was because we came back so far so fast. And I was looking at it and I was like, there is just stimulus coming from everywhere. The federal government is just sending people checks. The Federal Reserve is in full on uh, plunger protection status right now. And the difference is that this environment is still is not that. The Fed is not acting. They're refusing to act outside of a little bit of a balance sheet roll off, which is probably helping a bit. And you know, the federal government isn't really stimulating either. I mean, they're trying to with the tax cuts, I guess. So that might help the market a bit as well. That's some degree of government stimulus, but they're hurting the market, they're hurting the economy in other ways at the same time as they're helping it. So that to me, that's like the biggest difference. But we do know still where a lot of this is coming from. A lot of this still is just that same positioning squeeze that you know, and you have to update your thought process obviously as the market moves. Because what I thought when the SPY was at 510 was that we could see a positioning squeeze to 570. What I thought at the end of April was that we could see a positioning squeeze to MAOPEX. But those were predictions that I was making weeks ahead of time. And obviously data has continued to update. And the only direction that data has continued to update in is that there is the possibility of that positioning squeeze continuing even further through price and through time than I had originally thought, per the CTA still buying $13 billion worth of stock over the course of this week. So it's just an incredible move. And honestly, I'm annoyed about this move higher for a couple of reasons. But one of the main reasons why I'm annoyed about this move higher is we're still, as traders here, not left with a setup. Like, the way that markets work, the way that markets create opportunity and create setups is because they go through periods of expansion and consolidation over time. They go through periods of directional movement followed by periods of correction. It's the periods of correction. It's the periods of time of consolidation that actually is what creates the trading setups for us. When you're having a market that's just expanding and expanding and expanding and expanding, you don't actually get trade setups from it, and that kind of sucks. Like what I have been talking about is like, okay, and this is what I really thought was going to happen coming into today's trading session. I was like, all right, I don't know exactly what's going to happen today. Stabilization is I think very possible. I mean, if the market starts just going sideways up here, and it's a little bit of a balance of interest rates getting out of control, this negative news, the upside extension weighing on us, meeting that further corporate bid and further CTA bid, or maybe we just start going, maybe we go sideways here. That would be just fine. And I guess it's possible that we still go sideways. We close somewhere near Friday's high. But you're going to need a lot of sideways to really let this market fully catch up. So you've got that, maybe that way the market could set up. Though I thought that would happen at lower prices, or I thought even a better setup, even for people that want to be bullish, would have been a better price correction. Like, people that want to buy this market, I can't condone buying the gap down this morning, because despite that gap down, you still have $5 of extension off the ADMA. I can't condone tomorrow morning, if we open up at the same price that we're closing, let's just say, I can't condone buying this price. You're chasing price. And look, this is what I talk about, right? We work in a game of probabilities. Therefore, when you are working in probabilities, when you're working with the market in a long enough of a time frame as a trader, anything that can happen will happen. You'll see it all. But I can't. I don't position myself as a trader for rare one-off moves. I don't position myself for the. I mean, I when I say I don't position myself for it, I mean from a reward perspective, not a risk perspective. From a risk perspective, you need to be prepared for that 0.1% outlier probability move that could blow your account up. You have to be prepared for that. But from a reward perspective, I don't chase reward for the 0.1% probability situation, unless maybe the reward compared to the risk is just, the number still works out. But generally speaking, that's not what I'm going to do. So I can't promise. Again, let's say tomorrow we open up at this exact same price. We open up at 594 spot 50 in the SPYs, and off of that we continue to all-time highs. I don't look at the market after the fact and say, "Oh yeah, that was the right thing to do. We should buy 600 tomorrow because the market's going to go to 620 in a straight line." That could happen, but I will never say to buy that, because the probability of that happening is just so low. It sets you up for a bad risk reward and a low probability of success. So I guess what I'm trying to say is, when the market gives the lower probability move that is a bad risk reward and a low probability of success, that will happen sometimes. It's not a good idea to buy it, even if it works, is what I'm trying to get across. And the unfortunate part about the way that we got bought back up today is it just doesn't leave us with a setup. There's a bull argument to make about this market. There's a bear argument to make about this market. The technicals, without a doubt, are indicating the bull side of the argument, right? And to me, at the end of the day, that's the most important thing, is that the technicals are bullish. But even with bullish technicals, I need a trade setup to buy them. And up and up and up, and short-term tactical 5-6 days in a row in the green, and every single day the market being $10 extended from the ADMA. It's just not a market that I'm ever going to buy, because 199 times out of 200, that's not going to be a fruitful purchase. And if this happens to be the one out of 200 where it is, well, so be it. I don't need to capture that move. I still need to be prepared for the other side, though, right? It's one thing to not capture a low probability move, it's something else to blow your account up because a low probability move happens and you were positioned for the other direction. So while I'll advocate not to buy tomorrow, I won't necessarily advocate to short. Or if I do, it'll be the exact same way we always do it. It'll be with a signal, with a way to manage risk. And then if you're wrong because the lower probability situation happens or whatever, then you lose your risk and you live to fight another day. You live to trade the next setup and the next setup and the next setup and the next setup. And by doing the right things on every single setup on repeat over and over and over again, that's how you actually end up making money in the business. Not because you could have bought 592 today for a move to 595. That's just silly. So yeah, I mean that's really where we're at. Kind of just a crazy market. I seriously like up there as the strongest, if not the strongest I've ever seen. Um, and we still have a really strong bid that we are going to be dealing with throughout the course of a kind of holiday week. It's a full week, but we're off on Monday, and that's pretty much it. So that's all that I got. I'm happy to answer any questions you guys have. Why do I think it's so strong? I kind of just explained that. It's a combination of buying from the underpositioned funds that are underpositioned throughout this move and are chasing back in per this chart with the Goldman, and a combination of systematic buying at the same time in a market that is still lower liquidity than average. That's why it's so strong. But yeah, it's phenomenal, seriously. What else? Scrolling up here on the VTF a little bit, I think the first thing I'm seeing is from Dave S at 416. So if anybody puts something in prior to that, just copy and paste it back in. From Dave S, talking about longer term portfolio positioning, I currently do not have an opinion that is making me very much money in this market. Not interested in my opinion being right, just that it doesn't lose me money. If I can be wrong and still capture upside moves, that would be ideal, for sure. I'm underweight equities due to not putting much cash to work at the moment. If I'm bearish on the market but don't want to be in cash but also not fully in stocks, would you consider buying TLT at the support level to be good for upside and also be okay as a longer term purchase to hedge against the market, or is that inverse relationship not applicable here? Yeah, so I almost feel like you're asking me more of a investing question than a trading question, um, about being nervous to basically chase this market and having a bearish thought process and not wanting to chase into bad pricing. So again, it feels more like an investment question than a trading question. The problem with using TLT is that it's not like TLT, if you just want to use this for short term, it's not like it doesn't have risk, right? You know that if you own a treasury bond and you hold it to maturity, that you're going to get the full percentage of that return if you hold it to maturity. But if you're buying this as like a short-term instrument off of support, like you're saying, in as a substitute for cash until the stock market gives you a better spot to be able to buy, then you're at the whim of the price action of the TLT. So sure, if it continues to hold support at 85, it never loses 85, then you're never going to lose money on that TLT. But I would argue that one potential way in which the equity market goes down is because TLT is losing 85, in which case then when you're ready to rotate back into equities, you're taking a loss in the TLT, you're realizing a loss in the TLT to then be able to buy those stocks because TLT getting below 85 was the trigger for the stocks to go down. So I don't know. I mean, look, I'm actively trading this market. Like I said, this seems like more of an investing question than a trading question. I mean, I could tell you for one of the retail accounts I have, it gives 4.1% interest on my cash without any risk. So I have been in a similar thought process to you, where I'm generally, for investing purposes, a believer in dollar cost averaging. Just all the studies show. This is what I like to preach to my wife, and she's fully on board on this thought process. She's not a professional trader, professional investor. She's got a job. She makes money, and she likes the stock market, and she likes companies that make up the stock market that she uses. What does she use? She uses Apple. She uses Google. She's on Instagram. So Meta. Like the same things. So she has just had a lot of success by taking a percentage of her paycheck, and regardless of the price that those stocks are trading at, just buying a little bit every single month. So I'm a big believer in that on the investing side. It's not to say I don't try to time it a little bit as well. So I kind of combine, like, I'm going to put money into my account every single month. And I try not to trade that account on purpose, because I don't need to trade my retail account. I trade my professional account. Um, but recently as well, I've also been saying to myself, like, hey, I don't know if I want the risk of the stock market with some of these overhangs right now to the economy and everything, and I can get 4.1% on the cash. So and that is also super liquid. That I'm not going to take a loss on if TLT moves down. At a certain point, the brokerage might decide to reduce the interest rate, and honestly, at a certain point of that interest rate, it would make me more incentivized to buy stocks. If that interest rate offer was 2% instead of 4.1%, I probably would be putting less cash into it and buying more stocks. But it's not. 4.1% is a healthy number when I view a lot of uncertainty into the equity market. So I'm kind of combining that dollar cost averaging with just letting that cash just build through the interest rate a little bit, and waiting until I feel a little bit more confident about the economy. And confident about the economy doesn't necessarily mean that I need stocks to go down, so I'm buying a dip, though that would be nice. You have to also recognize that, like, and I don't do this. Like, I don't sell. Like I said, I don't trade my retail account, so I don't sell my stocks in my retail account. I don't time the market in my retail account with selling to be able to rebuy at a better price or anything like that. When I called the top of the market in February for us as traders, I sold 0 stocks in my PA as a result of that, in my personal retail account. It's just a matter of more of, like, the cash that I'm putting to work going forward, how I'm gonna be implementing it. So yeah, I think that kind of answers your question, and I hope that helps. What else here? From Rich N. The monthly chart momentum continuation hammer of 425 is even more pronounced than 320. I don't have a monthly. I can look at this weekly chart's nuts though too. Yeah, the comments said about they were negative. So that was the other thing. So Pete just said the Japan and China comments had no impact whatsoever on the market, and that was another thing. It seemed to me like the bad news was piling up this morning. You had obviously the Moody's downgrade, but you had Japan come out and basically be like, yeah, we're which has been a consistent message from them. So maybe it's not necessarily new, but the difference is time is going by. I think when the pause was first announced on April 9th, if Japan on April 16th says, hey, we're not going to rush into a deal, we're not just going to agree to any old deal, we want it to be good terms. And you look at that and you go, okay, not ideal, we want to get deals done as fast as possible, fine. But now we're at May 19th. So time is ticking, and the closer that we get to those dates where the 90-day pause ends, you would think that these headlines, like the ones that came out of Japan and China this morning, start to impact the market more. Now, I don't know if maybe it doesn't matter because at some point, supposedly in the next couple of weeks, the U.S. government is just going to like issue a letter to every single country that it hasn't had time to negotiate with on what their terms are going to be. You have to assume that that letter with what those terms are going to be is an improvement, meaning lower tariffs compared to the poster board that Donald Trump came out with on Tariff Liberation Day. Because otherwise, the US government wouldn't say, hey, we're sending you a letter of what your number is going to be. They'd be saying, hey, sorry, we didn't have time to get to you, so you're just going to deal with that number that we set on Liberation Day until we get to you, right? So you got to assume it's going to be somewhat better than what has been originally said on that Liberation Day. But we don't know what it's going to look like. But maybe the market at this point is assuming that it's going to be good. And if we don't get a deal done with Japan by whatever the date is, what's it? It's a June date, right? Or is it a July date? I guess it's a July date, right? If we don't get a deal done with Japan, well, then they're just going to get a letter too, and it'll be better than what it was. But the China headline on, the United States has already violated what they agreed to in Geneva. That seemed like a real nasty headline. But no impact whatsoever. This market is still just absorbing any negative headline that can come out. And I'll tell you that the crazy part about this trading business, because I've seen it happen so many times. I've seen these environments before. Not like, I was just saying, this is pretty unique just in the degree and speed of the up move. It's historic in terms of price action. But I've seen other markets that were like grindy to the upside ignore every single negative thing that comes out. They ignore it, they ignore it, they ignore it, and then all of a sudden, seemingly randomly, it starts to matter. And then all of a sudden, those same headlines that have been out for 2 weeks, CNBC is getting on there and they're blaming the down move on the market for the headline that we already knew about for the last 2 weeks. It's one of the most incredible things about trading, actually, is that the market can just ignore, and then all of a sudden, one day they decide they care and it matters. And a lot of the times, that one day when all of a sudden it matters corresponds with an important market dynamics event, which I would harken back to February OPEX of 2025. I would also harken back to February OPEX of 2020 as two extreme examples. But, it can also be hard to pinpoint necessarily, like, maybe it could have been this May OPEX that we just had in combination with these headlines. Obviously it wasn't, and all the data actually pointed to this May OPEX actually not mattering too much from a market dynamics perspective. But yeah, incredible the amount of negative headlines that the market was able to ignore today. From Richard, also it was day one down, so how many times out of 10 does that work, buying a day one down? Yeah, for sure. Day one down, potentially trapping people from the last couple days of buying in the market just for it to immediately get bought back up. But like someone said earlier, I think it has a lot to do with this chart, a lot to do with this positioning chart, sentiment positioning chart. What else? From Sherry, if the dollar continues to drop, if the DXY drops below 100, what would be the impact of equities? So I just have the chart of UUP. I don't have a chart of the DXY specifically. April lows is $27. We're kind of far away from that right now with how this thing moves. When it comes to, I think, dollar moves, it also depends on, it's not just getting above or below a level, it's the speed in which it happens and the reason in which it happens. Generally speaking, a weaker dollar is good for the stock market. It just makes assets higher priced, whether it's a commodity asset or it's a stock market. So generally, a weaker dollar, it's gonna be good for these companies. And we actually saw periods of time over the course of the last 2 or 3 years or whatever, where the dollar was actually too strong, and then you would see, you got to keep in mind about these S&P 500 companies. I don't know what the percentage is, but they get a massive amount of their revenue percentage comes from overseas. And when the dollar gets too strong, actually, and they report earnings, you'll see them miss on an earnings report and blame FX headwinds because of it. This is actually the opposite right now. Weaker dollar is great for those companies that are doing overseas business, generally speaking, and it just makes stocks trade at a higher price. So if we were to kind of grind lower, that's going to not only potentially not be bad for the market, but it's probably good for the market. If we have fast acceleration lower because people are selling US dollars and US dollar assets who are abroad because they don't want to touch them anymore, then that becomes a different situation. And that was more of the fear in the April down move, right? That April down move was more about, oh my God, is US exceptionalism over? And they're just selling anything that's dollar related, including the dollar. That's going to have a negative impact on equities. But otherwise, a grind lower will have a positive impact on equities, most likely. From Gregory, it is interesting from a purely retail perspective that longs have not really gotten paid over the last 4 to 5 days either, materially. Reddit, Nvidia, Palantir, Hims, Tesla, most of the retail darlings are sideways to down in total over this period. Calls bought last week. Any big long positionings originated since last Wednesday, even or not in the money, you're up materially and a lot are down. Yeah, it's been an interesting market, and this has been one of the other things that's frustrated me a little bit about this rally. And I think someone else mentioned it in the VTF this morning, but I can tell you it's definitely happening with me. My longs are underperforming my shorts. My shorts are more equity correlated, like index correlated. I mean, a couple of them, two of the bigger ones are outright indexes, the TQQQ and the SPXL, and these other couple that I have are a little bit more correlated. And it's like, man, SPY broke highs again. But if I type up every long that I'm in, I wonder if any of them are above last week's high. I don't know. Let's take a look. VKTX is not above last week's high. VAL is not even close to being above last week's high. PEN is not even close to being above last week's high. Snap is not even close to being above last week's high. Unity is a little bit better, but it's not above last week's high. Path, I looked at that one already, I think. Not above last week's high. S, not above last week's high. These are my longs. Alibaba, not above last week's high. JD, not above last week's high. Chevron, not above last week's high. I got some other ones that don't trade very correlated with the market, but whatever, we can look at them anyway. SPIR kind of is. Still not above last week's high, actually, but better than some of the other ones I looked at. TSE, I mean, this one had earnings. It got smoked on earnings. KLXE, nope. So there we go. I just went through every long that I'm in. BYON, this is probably the only one. I just went through every long that I'm in, and one of them is kind of doing what the market's done over the course of the last week. But I'm short basically SPYs. I'm short basically Qs. I've got some Nvidia short. It almost got there. Micron broke last week's high. Palantir's weakened out a little bit, but Tesla. Yeah, it's kind of crazy. It's one of those markets. From Sherry, today is TD7 on SPY. I don't know what that means. Should we wait for TD9 Wednesday to short? I don't know what that means. I don't know if you're just doing a day count or if it's like a DeMark indicator that you're saying. Oh, it's a DeMark. So I'm not a huge DeMark user. I'm not a huge DeMark user. I look at it as an additional layer of probability, but I don't make decisions on it. If I see that I've got like a DeMark 9, like I already really want to short, and then somebody lets me know I got a DeMark 9, then I like it even more. It's just like an extra piece of information that's on my side, an extra layer of probability on my side. I don't make decisions off of DeMarks. I think that just looking at them in a vacuum is faulty. But looking at them in conjunction with other things can be good. So no, I don't necessarily think that we need to wait for Wednesday to get a niner on the SPY to short. Does JXY, I don't know what JXY is, have an impact on, the end carry trade unwind? No, I don't think so. Not here. It's another thing that it depends how quick it happens. Um, if you get a very, very, very fast move because like a central bank does something unexpected, then it can have an impact on equities. But um, if it's a slower move, then it gives market participants enough time to be able to adjust, I think, than anything. We saw the yen carry trade have an impact on the market last August. And I think that alone last August was enough to force the market participants that got destroyed on that to adjust how they're going to be managing risk in those situations going forward so that it doesn't kind of happen again. So I think that it's almost too recent of an event to have a massive impact. And again, it's also at the rate of change. So you need a big surprise, I think, to come in from a central bank of Japan or in America to have that happen. All right, got through the VTF. Let me check out the YouTube, see if I have any friends in there today from AR. How do you feel about transferring between yourself and a more public figure trader? Did you feel more accountable with your trading and rules? So I get a more public figure. I guess me doing the whole YouTube thing and I've been on a lot more podcasts and stuff. That's only really happened the last handful of years, kind of since the COVID period. But I've been like managing traders and doing morning and afternoon meetings and teaching and stuff like that since 2013. So I've been doing that. I've been managing other traders and doing these meetings every day. For a long time, it was in person for 12 years. So I think that doing things a little bit more publicly didn't have any impact on me personally at all because it kind of just felt like a continuation of what I was already doing. What I can tell you is that back in the beginning of 2013, it's really, I guess, actually the end of 2012, when I started managing other traders, back then, the first thing that happened when I started managing other traders was my own trading suffered. That was the first thing that happened. They gave me this opportunity because obviously, I had been doing well and was adding scale on my trading, and I had already been helping some traders that were part of other groups that were newer and stuff, and they saw that I was good at it, and I've been teaching martial arts since I was 15. So for 25 years or whatever. I haven't really been doing as much of that since COVID either. So I was always kind of good at teaching. It just kind of led from one thing to the next. But again, when I first started managing traders back in 2013, the first thing that happened was my trading suffered. And that's because my style of trading at that time required me to watch the level 2 tick by tick. There was a lot of scalping, day trading, and everything. And all of a sudden, when I was managing other people, I couldn't really watch the market tick by tick in the same way. And then my trading suffered, and I kind of had to reinvent myself a little bit. The market also went through a big change at the end of 2012 that didn't help me. So it's kind of a bad combination of a market environment change, which, by the way, that's usually when experienced traders will go into trading slumps, is because the market environment changed, combined with a new responsibility. And I had to kind of change myself and reinvent myself. And that's when this whole concept that I still talk about today of game planning and following the game plan to the letter of the law became just so tremendously important to me, because I realized, like, all right, you've got less time and the market environment changed, but you just got to be able to follow your rules. And if you can make rule sets that are so uniform and disciplined, you can do those trades and follow those rule sets while you're doing other things at the same time. Which is why, I mean, look, do I get a little bit distracted? Sure. But I'm doing a morning meeting, I'm doing an afternoon meeting. Sometimes I'm trading at the same time. Sometimes I'm trading an earnings report while I'm having this exact same conversation with an afternoon meeting. And that's just an adjustment I had to make by having rules that enable me to do that. So, to directly answer your question, no, it hasn't really changed too much for me. But that's because this has kind of been an evolution that's been ongoing for just such a long time. From Sky Shaddix, does T3 have positions in New York City or are they remote? Email me on that and we can discuss it. Oldensmith at t3trading.com. Back to the VTF. Richard, RSI has been an overbought area for indexes for several days now as well. Is that another layer of probability to your train of thoughts? Yeah. So I know that so RSI is never something I've looked at on my own. I've never had an RSI on my chart. So it's another thing that I don't put a huge amount of weight behind. But I know Pat uses it and Pat talks about it. And when Pat provides me information or in certain scenarios, I'll even ask for it. Like, hey, I'm thinking about shorting this extended stock. What's the RSI look like on the 5-minute? And that might give me an extra layer of probability net to my conviction. But I know what Pat talks about all the time is that he really doesn't care about RSI on the daily. He only cares about it on the small time frame charts. So is the fact that RSI has been overbought on the indexes for several days in a row add to my train of thought, act as an additional layer of probability? Yeah, it does, but does it when I already have the market at $10 plus of extension off the ADMA for that 6 days in a row and short-term tactical in the green zone or whatever for 6 days in a row, or in the red, I forget which one is extended on the upside. I already know that the market's been extended consistently for multiple days. So it doesn't really do too much for me. And again, Pat always says that the daily chart RSI doesn't matter that much. So I'll go with what Pat says. And yeah, that's it. So sure, a little bit maybe. All right, just after 5 o'clock, it looks like I got through everything. So I'll end it there. Have a great night, everybody. Oh, hold on, Richard's sneaking in another one. Do you think maybe we are entering a newer regime of market like with the end of 2012? Not necessarily. I need this market. To me, this bull market hasn't proved itself yet because we haven't seen. I mean, maybe you could argue that today was it. But we haven't seen like a real pullback where buyers came in and created a higher low. That would indicate to me like a real new regime. That's why I wanted to retest the 570 area, 570 to 575. Let's just call it. Pull the market back. Show me the bulls come in. Show the bulls bring it back to new highs. Then I think if you're trying to be bearish, you got to throw in the towel because the bulls showed you they're there. They're here to stay. They bought that dip. We got the higher low, and that's it. When I'm dealing with a market that's just straight up, I don't necessarily feel that way. Though you could make an argument that today was that day. Today was the day where we had every negative news catalyst, every extension indicator had a gap down, but not enough, and the market got bought up. And maybe that is the signal. But I want a deeper test than that to really believe it. All right. Have a good night, everybody. See you all tomorrow. And if you're on YouTube, give me the thumbs up.